Everyone thinks stock exchanges are neutral platforms. They're not. They are some of the most profitable businesses ever built. Here's the trick: stock exchanges don't exist to help you trade. They exist to extract fees from every transaction that happens on them. And here's where it gets interesting. The older you go, the more naked this business model becomes. In 1602, the Dutch East India Company needed capital. Merchants gathered on the Amsterdam docks and started buying shares directly from each other. No building, no rules, no exchange, just cash and paper. But that chaos cost money. Brokers got lost, prices were unreliable, deals fell apart. Someone had to organize it. Exhibit 1: the fee structure. By the 1700s, London's stock market formalized. A building opened, rules appeared, and brokers paid for the privilege of trading there. A membership fee, a transaction fee per share. The exchange didn't own the companies being traded. It didn't manufacture anything. It simply provided the venue. And that venue became invaluable because liquidity, the ability to buy or sell fast, only exists when traders know where to find each other. The exchange solved that problem, and it charged for the solution. Exhibit 2: the liquidity trap. Here's the mechanics. More traders on an exchange means tighter spreads. The difference between the buy price and sell price shrinks. Tighter spreads attract more traders. More traders attract more companies wanting to list. More listings attract institutional investors, and institutional investors move enormous capital, so exchanges began competing to attract them. They lowered fees for high-volume players. They invested in faster technology. The New York Stock Exchange, founded in 1817, became dominant not because it was first, but because it had the most traders. And the most traders meant the best prices. Exhibit 3: where the money actually flows. Listing fees, membership fees, transaction fees per share, market data fees, and here's the trick: they sell the same data twice. Once to traders for real-time prices, once to the public delayed by minutes at a lower price. Data licensing became a separate revenue stream entirely. The NYSE generates billions annually from fees, not from owning assets. The exchange is a toll booth, not a factory. But there's a counterbalance: market makers. These are firms that guarantee liquidity by standing ready to buy or sell at any moment. They profit from the spread, buying at the bid, selling at the ask. Without them, an exchange would be a ghost town. So exchanges actually subsidize market makers with rebates, paying them to show up. The exchange pays to attract the traders it needs to survive. The fee model inverts. The exchange becomes a platform that pays for volume, not the other way around. Exhibit 4: the regulatory fee. Exchanges don't just collect revenue, they enforce rules. They police insider trading, they halt suspicious stocks, they maintain audit trails. These functions cost money, but they also protect the integrity that makes the exchange valuable in the first place. A market without trust is worthless, so the exchange's business model depends entirely on its reputation. One massive scandal, one rigged trade, one hidden fraud, and traders flee to a competitor. The fee structure, then, isn't just a revenue machine, it's the price of legitimacy. So here's what actually happened. Stock exchanges evolved from chaotic docks into organized platforms because organization has enormous value. Traders will pay for certainty. Companies will pay for access to capital. And the exchange, sitting in the middle, extracts fees from both sides. The business model hasn't changed in 400 years, only the scale has. Today's exchanges generate revenues in the billions by doing what Amsterdam brokers did in 1602. Providing a place where buyers and sellers can find each other with confidence. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to see how other everyday businesses hide their real profit centers. There's a new breakdown every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.